So we left with this concept of audit risk. We started off with the concept of audit risk. So let's recap this concept. Audit risk is what it is, the risk that the auditor expresses an inappropriate opinion when financial statements are materially misstated. Now, you need to understand that financial statements have got misstatements. What we're saying is that financial statements have got misstatements. That is to say, when we say financial statements have got misstatements, we're saying that financial statements have errors. Now, if financial statements have misstatements in them, what should be the opinion? Auditor should say, logically speaking, the auditor should say that financial statements do not give a true and fair view, financial statements contain material misstatements, that financial statements have not been prepared in all material respects in accordance with an applicable financial reporting framework. I think that's what the auditor should be saying. And so the opinion should be, correct opinion would be that financial statements are not appropriate. But what if the auditor says everything's all right, and auditor gives a clean chit? Auditor says financial statements are okay. There are no issues with the financial statements. Financial statements are just all right. So the issue is this particular exposure, this particular risk, whereby financial statements contain material misstatements, financial statements are not all right, financial statements are not okay, yet the auditor says financial statements are fine, financial statements give a true and fair view. This particular scenario is termed as audit risk, right? Remember, the converse of this is not true. What is the converse scenario? The converse scenario is where you would say financial statements are all right. In reality, there are no misstatements in the financial statements. Financial statements are all right. But the auditor says that financial statements are not appropriate. That's a hypothetical scenario. And that's why the standard setters have clearly and categorically said that audit risk is the risk that the auditor expresses an inappropriate opinion when FS are materially misstated. So when FS are materially misstated and auditor expresses an inappropriate opinion, this exposure is technically speaking termed as audit risk. Now, this is a very perplexing situation, or a very and this might sound a little naive situation to you, that public is relying on external auditor and public have all their eyes and trust on the external auditor, that okay, fine, although the directors may cheat us, or shareholders are like, directors may cheat us, management may cheat us, but auditor is an independent party, so the auditor would at least let us know what are the problems in the accounts, what are the problems in the financial statements. But the auditor themselves are facing this risk that they may not express an inappropriate opinion while the financial statements are materially misstated. This is a perplexing situation, a mind-boggling situation. So we need to first understand the root causes of this risk. The root causes of this risk first need to be understood, and only once we understand the root causes would we be able to reduce or manage those causes, so that we can reduce this audit risk down to an acceptably low level. The objective of the auditor would naturally be to reduce the audit risk down to an acceptably low level. Remember, audit risk cannot be reduced to nil. Audit risk cannot be reduced to zero, and that is because of the inherent limitations of audit that we covered in the last class. Because of these inherent limitations, you should be very clear in your mind that auditor cannot reduce the audit risk to zero. That's just not a possibility. Audit risk cannot be reduced to zero. Audit risk cannot be eliminated. It can only be reduced. So before you want to reduce your audit risk, I think you need to have a more comprehensive understanding of the underlying causes. That is, what are the principal reasons, what are the principal factors that actually give rise to audit risk, that give rise to this risk that the auditor expresses an inappropriate opinion while the financial statements are materially misstated. So for that matter, you need to know that audit risk is a function of ROM and detection risk. Audit risk is a function of ROM and detection risk. So there are two underlying factors, there are two underlying causes that lead to this risk that the auditor expresses an inappropriate opinion when FS are materially misstated. And what are they? Number one, it is ROM. ROM is risk of material misstatement. What is DR? DR is detection risk. So there are two reasons, two principal reasons why audit risk exists in real world, because there is something known as ROM, there is something known as risk of material misstatement, and there is something known as detection risk or DR. And these two factors contribute, these two factors lead to audit risk, or these two factors lead to the risk that the auditor expresses an inappropriate opinion when financial statements are materially misstated. So let's now understand these two factors in greater detail. As far as this ROM is concerned, risk of material misstatement, remember its definition and specifically the red component of the definition. Risk that FSR materially misstated prior to audit. Now, prior to audit is in red, and it is in red for a reason. What is the reason for that? Because if you miss out this expression prior to audit, remember, if you may be asked in the audit assurance exam to reproduce certain definitions, and audit risk is a concept that is tested both as a knowledge-based question as well as an application style question. So you need to memorize these definitions as well, and there are certain components of the definitions which you cannot miss on, and prior to audit is one of those components. If you don't mention prior to audit in the exam, remember, you will not get any marks. So mentioning prior to audit is mandatory, compulsory. So when we talk about ROM, we're saying risk that FSR prior to audit, before audit. The point to understand over here is, if we just quickly recall the responsibilities of the management. Remember, in the last class, we covered the responsibilities of the management and TCWG regarding FS, and it was over there that we learned that financial statements preparation is the responsibility of the management with oversight from TCWG. And I hope you can recall TCWG is basically the board of directors. So the management with oversight from TCWG is responsible for preparation of financial statements as per applicable financial reporting framework. So there is always a risk, there is always a chance that the financial statements which the management has prepared, because it is their responsibility, that might be materially misstated before the auditor has examined them, before the auditor has applied any procedures. So now we need to understand that why does this risk exist? Now we're basically doing a drilling exercise. I hope you can understand and appreciate that. What we're doing is precisely a drilling exercise, a risk. Now we need to understand, why does this risk exist that FSR materially misstated prior to audit? Why might financial statements be materially misstated prior to audit? That's due to two reasons. That's due to two reasons. That's due to IR and that's due to CR. Because ROM is a function of IR and CR. So because of IR and because of CR, the financial statements could be materially misstated. Now we need to understand further, we need to develop further detailed understanding of what is IR and what is CR. IR is inherent risk and CR is controlled risk. So Rome is a function of inherent risk and controlled risk, or Rome depends on inherent risk and controlled risk. Now let's understand inherent risk and controlled risk. But here comes in a problem. Before you can understand inherent risk and control risk, you need to understand two concepts. Unless you don't develop an understanding and appreciation of those two concepts, we cannot proceed further or we cannot further our understanding of the audit risk model. So while we're covering the concept of audit risk for a while, we're putting a pause on this model, on the audit risk model, and we're moving on to first understand the two concepts or the prerequisites for understanding audit risk. So what are those two concepts that you need to understand before we can proceed further with Rome? One is internal control and the other is assertions. These are super important concepts as far as the AA exam is concerned. You cannot expect to pass this exam without having a holistic understanding of these two concepts. So let's first understand these concepts so that you can be clear that what exactly an internal control is. Now remember, what is an internal control? A policy or procedure. What is internal control? Any policy procedure designed by management, TCWG. That policy could either be designed by the management or TCWG to achieve these objectives. In order to achieve these objectives, these four objectives, whatever policies, procedures, management, TCWG, that is the board of directors, frame in order to achieve these objectives, they are termed as internal controls. Now, you would think that every company has different objectives. So how can we generalize this concept? The issue is these objectives are common to most entities. Every entity would want to have reliable financial reporting. Every entity would want to have good value for money of operations. Every entity would have to comply with the laws and regulations, would have to prevent fraud, detect fraud, safeguard its assets. So these are the general objectives that most entities, if not all, would wish to achieve. And so in order to achieve these objectives, whenever you want to achieve something, you need to have some concrete policies, procedures, right? For example, in order to reduce the widespread of COVID-19, certain standard operating procedures were designed worldwide. Different countries adopted different measures in order to reduce the negativities or the adversaries that COVID-19 could create. So the point that I'm trying to make over here is that these are the objectives. In order to achieve objectives, you need to have certain procedures. So what, for example, in order to reduce the widespread spread of COVID-19, whatever standard operating procedures we are following, such as social distancing, such as wearing masks, such as the use of hand sanitizers, washing hands after every half hour, all of these standard operating procedures are actually controls to prevent, and what objective are they meant to achieve? So that we don't catch this virus, right? So I hope I'm making some sense. Similar is the case over here. There are certain objectives that companies need to achieve. For example, they need to make sure that their financial reporting is reliable. Financial statements give a true and fair view. They don't have misstatements. Companies also want to have good value for money of operations. That is 3 E's. You must have covered this concept in your performance management exam as well. Economy of operations, that is, you keep your costs down. efficiency of operations, you keep your productivity levels, the ratio of output and input high. Effectiveness, you achieve the principal objectives of the organization and has a more qualitative aspect to it. Compliance with laws and regulations. Entities need to comply with the law of the land. Whatever jurisdiction a company is operating in, it has to comply with the company law, with the employment law, with the law of tort, and whatever laws are there in that country, they need to be complied with by the company. Moreover, companies want to prevent fraud, to detect fraud, and they are also interested in preservation and safeguarding of the company's assets, that they don't get stolen, they should not be stolen, or theft or loss of such assets doesn't occur. So now these are the objectives that management or company needs to achieve, and in order to do that, the management or TCWG, they need to develop certain policies and procedures. For example, for in order to have reliable financial reporting, what sort of a policy could be there? That, for example, there are hierarchies within the accounts department, so that one person prepares bank reconciliation statement, another person reviews it, a third person approves it. One person prepares financial statement, another person reviews it. Audit committee, a subcommittee of the board of directors, they oversee financial statements. They challenge the management on the estimates that have been used on, for example, the going concern assumption that has been used, on the accuracy and completeness of the related party transactions, for example. So the point that you need to understand over here is, whatever policies, procedures, for example, these review procedures, these distribution of responsibilities amongst different people, that is one person preparing a document, another person reviewing a document, a third person approving a document. These are basically the procedures through which it is ensured that if one person makes a mistake, the other person identifies it and corrects it, so that there is reliable financial reporting. Financial statements give the correct picture. Then, in order to ensure good value for money of operations, companies need to have good certain sets of policies, procedures. For example, a company that has its operations dispersed in different locations of the country, for example, and they have similar needs of, for example, stationery, like every division, every branch needs a stationery or similar items. So for that matter, what the company would do is, the company needs to, what the company has a procedure, that it receives orders or purchase requisitions from all its branches for stationery requirement. It consolidates it, and then it places a single order with the vendor. Now, what is the concept of consolidating all the orders and then placing a single order? That is to achieve economies of scale, because when you will be buying in bulk, it is likely that you would be able to negotiate better pricing terms with the supplier. The supplier, your power as a buyer would increase, and so you can negotiate better with the supplier. This is not just with stationery, just one small example. This could apply to a host of other areas in the business, and so you need to be appreciative of this, that how economy can be brought into operations. Similarly, compliance with laws and regulations. In order to ensure compliance with laws and regulations, because I've worked in the compliance function as well, so there was a procedure design whereby I would uh, review the corporate websites of the regulatory authorities on a daily basis to see if at all they have posted any new laws or regulations, or any amendments to the existing laws and regulations. And then what I would do is, I would perform an impact assessment for my entities in order to see if at all there is any impact, and if at all there was any impact, then I would develop a system whereby compliance with those new laws or regulations was ensured. So this procedure of performing of undertaking this impact assessment is actually an example of an internal control. Similarly, in order to prevent, detect fraud, many companies have CCTVs on their retail outlets, in their warehouses, and that is meant to, for example, prevent theft and protect the assets of the company. So this is one concept that you need to understand: internal control. So what is an internal control? Any policy procedure that management TCWG designs to achieve these objectives, that is termed as an internal control. Remember, we talked about internal control in the last class, and I asked you to wait for the understanding of this concept. And it is for this reason that I asked you to wait. Remember, financial statements subject to audit are those of the entity prepared by management of the entity with oversight from TCWG. And what are the specific responsibilities? To prepare financial statements as per applicable financial reporting framework, that you already understand. Now you also understand that who is responsible for a sound system of internal control? Management and TCWG. Look at the definition of internal control. Policy procedure designed by whom? Management or TCWG. So internal controls design, development, and making sure that they are complied with is the principally it's the responsibility of management and TCWG. So the next concept now, please don't forget, we were studying audit risk, we were studying the components of audit risk, and we've just taken a break or a pause because in order to proceed further, we need to first understand these two concepts. So one concept is, I hope, clear to you, that is internal controls. Now let's understand the second concept. Second concept is again a super important concept, an extremely important concept as far as the AA exam is concerned, and as far as the basics of auditing are concerned. So what is that concept? The concept is assertions. What is assertions? Representations / claims by management, explicit or otherwise, that are embodied in the FS as used by the auditor to consider the different types of potential misstatements that may occur. Now that looks a very confusing definition, a very difficult concept, but it is not. Simple, the concept is very simple. And I would use an example to illustrate this concept. When we talk about financial statements, you should understand that financial statements is equal to statement of financial position plus statement of comprehensive plus statement of changes in equity plus statement of cash flows plus notes to the financial statements. These are the 5 things that make up your financial statements. Statement of financial position plus statement of comprehensive income plus statement of changes in equity plus statement of cash flows plus notes to the financial statements. So, for example, if you look at statement of comprehensive income starts with the line item revenue, right? Statement of comprehensive income starts with the line item revenue or sales. Now, when management puts a figure of against revenue of say $1 million, and it says revenue is $1 million, the management directly or indirectly is making some claims. The management directly or indirectly is making some claims regarding this $1 million worth of revenue. And what are those claims? Those claims are that this 1 million rupees of $1 million of revenue is not bogus. It's not fake. It's genuine revenue. It has actually occurred. The management is directly or indirectly saying that there's nothing else that could be should be recognized in this number. I mean, this number $1 million is complete in all respects. When there isn't any revenue that was supposed to be recorded, but the management hasn't recorded it. Another claim that the management is making is that revenue, this $1 million, it contains recognition of amounts at recognition of values at correct amounts. What do we mean by that? For example, it hasn't happened. The management is directly or indirectly claiming that if an invoice was of $100,000, it has been recorded as such. It hasn't happened that it was recorded at $120,000 or that it was recorded at $80,000. The management directly or indirectly is also making another claim, and that is this $1 million has no correlation with the prior period revenue or the next period revenue. This $1 million in its entirety pertains to the current accounting period for which the financial statements have been prepared. The management directly or indirectly is also making a claim that because we say revenue arises in the ordinary course of business activity, so the management is saying this $1 million hasn't got gain on disposal of items of property, plant, and equipment, because that's not the ordinary course of business activities of the entity. Or for example, if it's a non-banking, non-financial institution, then interest income hasn't been recognized in the revenue number, because that is not something which arises in the ordinary course of entities' business activities. So these all claims are basically assertions, right? These are the representations by management, explicit or otherwise, that is directly or indirectly, that are embodied in the financial statements, which are a part of financial statements. I mean, revenue, for example, is a part of financial statements. And the auditor actually makes these claims as his basis of testing. I mean, auditor is actually verifying how true these claims are, right? Because for example, if the auditor performed certain testing procedures, certain examination procedures, and concluded that no, this $1 million has a lot of revenue which should have been recognized in the prior period, or which doesn't pertain to this accounting period, it actually pertains to the next accounting period, then don't you think this is a material misstatement? So to aid the auditor's thinking process, to help the auditor's thinking process, auditor makes these claims as the basis for his thinking and for his testing. So these are the representations, claims, loosely speaking, by management, explicit or otherwise, that are embodied in the financial statements as used by the auditor to consider the different types of potential misstatements that may occur. So this actually is a brainstorming or an aid to the thinking process of the auditor, that what sort of potential misstatements could occur in these claims. So now these claims or assertions are about class of transactions, events, and related disclosures. These assertions or claims are about account balances and related disclosures. A simple thing to keep in mind is, like in financial reporting, in the language of financial reporting, you have statement of comprehensive income, and statement of all the line items in the statement of comprehensive income, they are examples of class of transactions or events in audit language. In the language of the auditor, whatever line items appear on the statement of comprehensive income, they are examples of class of transactions events. Whatever items appear on the statement of financial position, they are basically your account balances, right? So whatever line items appear on the statement of financial position, they are examples of account balances. Whatever line items appear on the statement of comprehensive income, they are examples of class of transaction. So the example that we've just discussed, revenue. Revenue is an item that appears on the statement of comprehensive income, and so in auditing language, it is a class of transaction. Receivable, on the other hand, appears on the statement of financial position. So in auditing language, it's an account balance. I hope this is clear. Now, what about statement of cash flows, statement of changes in equity, and the notes to the accounts? Remember, statement of cash flows, statement of changes in equity, and notes to the account are just amplification and additional information of what is there on the statement of financial position and statement of comprehensive income. So they're basically more related to presentation and disclosures, which are also covered. But the principal statements are the statement of financial position and the statement of comprehensive income. The rest of statement of cash flow, statement of changes in equity, and notes to the account, they're there to just expand on what's there in the statement of comprehensive income and the statement of financial position. So within the financial statements, I think you can create this segregation that your principal financial statements are the statement of comprehensive income and the statement of financial position, and the rest of the components of the financial statements are amplification or explanation of the statement of financial position and the statement of comprehensive income. Now let's understand these class assertions about class of transaction. So these are the assertions: occurrence, it's a claim by the management; completeness, accuracy, cutoff, classification, presentation. About account balances, instead of using this terminology of occurrence, for account balances, the term which is used is existence. Completeness is common to both. In addition to accuracy, valuation and allocation, fair valuation of fixed assets, of items of investment property, rights and obligations. Classification common to both. Presentation. So is revenue an assertion? No. Assertion is occurrence. Assertion is completeness. Assertion is accuracy. Assertion is cutoff. Assertion is classification. Assertion is presentation. Now, these assertions have been defined. While they're quite self-explanatory in terms of their captions or in terms of their terms, but still they have been defined categorically and clearly in the auditing standard. So as far as occurrence or existence is concerned, transactions and events that have been recorded or disclosed have occurred, and such transactions events pertain to the entity or existence. For class of for account balances, you have existence. So assets, liabilities, and equity interests, they exist or not. That's basically the concept. So occurrence is whether the recorded transactions exist or they don't exist. Whether the recorded transactions they've occurred or not, and whether they relate to the entity or not. Completeness, those transactions which should have been recorded have been recorded. This is a very important thing. Completeness, all transactions or all assets, liabilities, equity, interest that were supposed to be recorded because they met the recognition criteria, and so they were supposed to be recorded, whether they have been recorded or not. Accuracy. Now here you would see 3A and 3B because accuracy relates to class of transactions, while accuracy, valuation, and allocation, this relates to account balances. This relates to class of transaction and this relates to account balances. So accuracy means recording at correct amounts, appropriately recorded. Disclosures are appropriately measured and described. While accuracy, valuation, allocation, because it pertains to account balances like assets, liabilities, equity, interests, whether they have been included at appropriate amounts. Any valuation or allocation adjustments have been appropriately recorded. For example, fair valuation of financial instruments, fair valuation of investment property, whether they have been properly recorded or not. Cutoff. Transactions, events recorded in the correct accounting period. Rights and obligation. Here it says the entity holds or controls the rights to assets, and liabilities are the obligations of the entity. Now, you need to understand a very basic, very important concept over here, and that concept is the entity holds or controls the right to assets. What do we mean by that? By that, we mean entity has control over the assets. We haven't talked about the fact that entity has ownership of the asset, because the concept of leased assets also exists. And even if you look into the definition of asset as per the conceptual framework, what does the definition says? An asset is a resource controlled by the entity as a result of past event. It doesn't say is owned by the entity as a result of past event, because you may not be owning an asset. Ownership is not the only criteria for you to be able to recognize an asset. You may not be owning an asset, yet it's there on your statement of financial position. Classification. Recording of transactions, events, or account assets, liabilities in proper accounts. That is very important. Like we talked about your revenue. If interest income has been classified as revenue, or if gain on disposal of property, plant, and equipment has been classified in the revenue account, it means it's a misclassification. This would constitute a misclassification. Presentation, last but not least, presentation. And presentation is something which is again common to both class of transactions and account balances. Presentation means appropriate aggregation or disaggregation, clear description, and disclosures are relevant, understandable in the context of the requirements of the applicable financial reporting framework. In short, whatever presentation and disclosure requirements are there in the applicable financial reporting framework, they have been duly complied with. Due compliance has been ensured with the disclosures and the applicable financial reporting framework. So if you look into the assertions, these claims, presentation is common, classification is common, completeness is common, occurrence and existence are a replica of each other. It's just a change of the terms to reflect the nature of assets, liabilities, equity interest versus the nature of items appearing in the statement of comprehensive income. Accuracy, valuation, and allocation, again there's an overlap in that the additional element of valuation is there in the account balances. Cutoff and rights and obligations, these two are just independent. So these were the prerequisite for understanding audit risks. Now you understand internal control and assertions.